Okay, good morning. Time now 5 minutes past 8 a.m. Sorry, keep everyone waiting. It's the Tuesday, November 14th, 2023 in Japan Standard Time. Welcome to another edition of the World Bank Tokyo Online Morning Seminar. My name is Koichi Omori. I am a Senior External Affairs Officer of the World Bank based in Tokyo. Our online morning seminar is introducing the latest World Bank publication presented by the authors of those report. This morning, we are featuring the commodity market outlook, which was issued actually about 2 weeks ago. We have two economists joining us from Washington, D.C. We have Valerie Massa-Blackman, who is a lead economist in the Prospect Group of the World Bank. And also we have senior energy economist Paolo Agnolizzi from the same Prospect Group of the World Bank. Next 35-40 minutes, we'll listen to their presentation sharing the main point and key messages of the latest edition of the Commodity Market Outlook. And then after their presentation, as usual, I will read the question that we received from you in advance. And also, if you did not have opportunity to send your question in advance, please send your question by using the online form posted on the announcement page of the seminar, or you can simply post your question on the chat section of the YouTube screen. I'll read your question on your behalf after the presentation by our speakers. So with that, I'd like to formally invite both Valerie and Paolo to come in to start the presentation. Over to you. Thank you very much.
Very much, Koichi. And thank you for everybody for attending. We're going to take you through the main contents of the commodity markets outlook just published, which is very much influenced by the geopolitical risks faced in the commodity markets. If we move to the next slide, we can go through the questions that will be used in this presentation. And we will be talking about energy prices and the risks related to the outlook of the energy prices. We will do the same also for the agriculture and food prices, and there will be some discussion also about the recent trends in food insecurity. And the next category of commodities that we will cover is essentially metals and critical minerals, and Valerie will take you through these markets. And finally, Valerie will talk about the special focus of the commodities market outlook, which is essentially the impact of a major escalation of the Middle East conflict. Next, please. We will start with energy. And before we go to energy, actually a brief summary of the main findings, the main contents of the commodity market outlooks. Overall, falling prices, a lot of commodities have displayed falling prices in the last 6 months, but unfortunately created risks. With regard to the outlook, we see again the commodity prices falling in 2024 and 2025, and also in 2023. That applies to energy prices in particular. We have some reference about the Brent prices on the slide. Also to agriculture prices. It's slightly different for metal prices because we expect prices to decline in 2023 and 2024, but probably to bounce back in 2025 as a consequence of robust demand, particularly from China, but also from the global economy. Several risks, greater risks, as the slide says, to this outlook, and in particularly for energy. We have the escalation of the Middle East affecting oil and gas, a general slowdown of economic activity, and also the continuation of OPEC cuts recently announced. And in agriculture, we have a number of risks, including the El Nino, trade restrictions on the positive side. In the case of the Black Sea are receding risk, but there is also the additional risk of increasing energy prices, which will feed into agricultural prices. And finally, in the case of metals, the main risks are related to the slower than expected demand from China and the associated confidence crisis with the property sector in China. And if we move in terms of prices, as you in the first chart, we see two different groups of commodities. On one side, we have metals and agriculture, where we see kind of a decrease in prices recently, and throughout the period since May 2022. And it's slightly different from energy, because we have seen a kind of a bounce back in prices, and particularly oil, but also natural gas. And that bounce back influences essentially the commodities price index, because the weight of energy commodities is very, very high. Overall, falling prices with perhaps a bounce back, but definitely prices are still very, very high compared to the historical levels. And in the second chart is a comparison between the 2015-19 average and the prices that we have seen between August and October 2023. All of them are well above the historical levels. And next, please. Here we look at the kind of price forecast, which has been briefly mentioned in the previous slide. Overall, a kind of falling prices across commodities, with the exception of the bounce back in 2025 for metals, and the comparison between the future prices before the latest conflict in the Middle East and today and yesterday's essentially. Friday, sorry, and Friday future is fairly similar. A further confirmation that essentially the risk from the conflict are receding, at least based on commodity markets. Next one, please. Now we are focusing on energy, so the outlook in energy prices and the risk. We move to the next one. A lot of potential narratives in these slides, but one which is probably worth mentioning is the kind of bounce back in the Brent starting essentially in July 2023, and also the shrinking gap between the Brent and the Urals. There will be more discussion later on. Natural gas prices, again, the red line is very, I would like to draw your attention to the red line, which is the natural gas in Europe. And in particular, you see a bounce back, which has increased a few months ago, but in particularly since the latest conflict in the Middle East. And on the perhaps different from the two other commodities, in the case of coal, we have the Australian and the South African benchmark. In both cases, we continue to see decreasing prices. Next one, please. With regard to the short-term impact, the conflict in the Middle East has so far had limited impact, and we are currently at $82 per barrel, which is lower for the Brent, which is lower than when the conflict started. European natural gas prices has increased considerably since the start of the conflict, but it's also coming down to an extent, although lower than the Brent. And in terms of volatility, you can see in the last group of chart, the before and after the latest conflict in the Middle East, the volatility has increased of the Brent, but not considerably so. So a small uptick in volatility, conveying a kind of a higher uncertainty though. And next slide, please. Here, I would like to draw your attention to the oil production. Several events affecting the oil production recently, starting with several announcements of cuts from OPEC Plus and the most recent announcement from Russia and Saudi Arabia about 1.3 million barrel cuts per day up to December 2024. There is plenty of spare capacity in the market. There is about more than 5 million barrels per day in spare capacity in OPEC Plus, and that the fact that spare capacity is not being put to use is one of the reasons why we have such high prices. On the positive side, increase in production from the United States, from shale oil, and that has occurred despite lower number of rigs being used, therefore hinting at a higher productivity. Next one, please. And demand has been very resilient for oil, in particularly for China. That shows in the first slide, and sorry, in the first chart, and also in the middle chart. That applies to 2023. And in 2023, the demand from other group of countries has been actually much smaller. The resilient demand from China has occurred throughout a number of oil products. We have naphtha related to petrochemicals and essentially industrial use, and also a number of oil products for transport, in particular diesel, gasoline, and jet fuel, kerosene. In 2024, one expects a much lower demand. And if we move to the next one, that's perfect, thank you. And in terms of trade, also another very important factor on the oil market, this has been a bit of entrenching previous trend. So we had a considerable shift in the trend from oil export from Russia, and in particular European Union not taking very little oil, and the UK and US none at all. And one can notice the increase in the other category in the second bar, and that is very much related to the fact that Russia has essentially put together a dark fleet of tankers which essentially receive insurance from not the EU, G7 or Norway countries, and that is much more difficult to track the destination of this fleet. And that is one of the reasons why we have a shrinking gap between Brent and Urals. And next one, please. In terms of a natural gas consumption, quite a tight market, despite in 2023, there has been a kind of a more or less plateauing, more or less constant level of demand and consumption, level of production and consumption. In 2024, we see an increase in consumption, and production matching that increase in consumption, and therefore the market will continue to be tight despite in reduction in consumption from European, and which is shown in the middle graph. And one of the calming factor for the level of price on the market is the fact that the storage levels are particularly high, and we show the chart for the European storage, and the same applies to some storages in Asia, actually, to an extent also in the United States. And next one, please. And here we have finally a brief discussion of the coal. In the coal market, we had generally kind of a plateauing demand in 2023 and 2024. Essentially, so far in 2023, very much driven by China and India on the positive side, while consumption from the United States and European Union is shrinking. And this kind of plateauing level of consumption will be essentially met by an increase in production, particularly in 2023, and driven by China and India. Therefore, we would expect the price of coal to decrease. And next one. And in terms of trade, we have seen for coal and natural gas, we have seen a bit of entrenching of pre-existing trend. So with a lot of LNG from the US being sent to European Union more and more, as you can see with the bar with the blue bar, and with regard to coal, the European Union has managed to increase considerably the sources of supply for coal, and that has made it possible essentially cutting any imports from Russia. And next one, please. We are moving now to the risk, which we have already discussed briefly in the first slide. So I will go quickly through them. We have an upside risk related to the escalation of the Middle East conflict for oil, continuation of the OPEC cuts, and there is a possibility of a slowdown in the supply from US shale, and that is directly related to the fact that there has been a considerable increase in cost in the shale production, as it can be seen in the chart. With regard to the downside risk, very much a slowdown in economic activity, and especially in China. And this slowdown, next one, please. And this slowdown in China might affect also natural gas, essentially, and also in particularly coal as a kind of downside risk, as you can see in this slide. And in the case of natural gas, upside risk are related to the conflict in the Middle East, but also to the market is so tight and so very much dependent on the LNG that any problem related to the supply of LNG causes quite a bit of apprehension in the market, and that has continued for quite a long time and might continue into the future. Plus, we have some weather factors related to El Nino affecting potentially demand for natural gas and coal, as well as production of coal in some cases. And that is the end of the energy section. If we move to the agriculture one and to the next slide, we start essentially with the food price index. Here, as you can see, there are decreasing prices for grains and oils, but not for other food, which is very much related to issues related to oranges, and essentially, and in particular, sugar. And overall prices in 2023 Q3 higher than the long-term average between 2015 and 2019, with the exception of raw material and beverages. And next one, please. Rice is kind of a very important. We had a spike in the price of rice recently. That is due very much to a restriction on trade introduced by India. And you can see on the right-hand side, on the right graph, that India has about 40% of global exports. So that is a very important player. And this is a very kind of a thinly traded commodity, rice. And also, you know, the four major exporters have about 90% of the market in terms of export. So therefore, its spikes can be quite frequent, especially when introducing trade restrictions, as trade is already thin. We move to the next one, and then in that case, we will be talking about supply of grains and edible oils. Grains, we have seen a decrease in 2022 as a consequence of the Russian invasion of Ukraine, and still the market hasn't bounced back to pre-invasion levels. On the positive side, though, edible oils, the supply in 2022 and 2023 has been very healthy, and a considerable increase in supply. Next one, please. And if focusing now on the grain yields, there has been kind of a long-term increase in the yield, which is the productivity of essentially, which is the production per square meter of per hectare. And other significant trends in the market is first of all the trade, the share. The traded grain as a share of production has increased throughout in the last in the three bars, in the three periods that we selected, and at the same time market concentration has also decreased, perhaps as a consequence of the increase in trade, with the exception of rice. Next one, please. Focusing now on fertilizer. Fertilizer very much impacted by the energy prices, and as a consequence, we have now we can see decreasing fertilizer prices, with the except of the recent bounce back in the last few months. And this decrease in fertilizer has helped increasing the affordability index. And recently, as you can see, there has been a considerable decrease in the index on the right-hand side, which means more affordable. And the last few slides from me are related to coffee and prices and production. Production in particularly hasn't increased much recently, and we see a divergence between the coffee Arabica and the coffee Robusta. And in particular, the coffee Robusta is produced mainly in Vietnam, and there have been some issues with production in Vietnam, hence the increase in price. And the next one, talking about cocoa prices, which has been a considerable increase due to El Nino, and in particular production in West Africa, which is Ghana and Cote d'Ivoire, have been impacted by that, impacted negatively, and hence the increase on prices. And the next one is talking about the risk related to the agriculture price forecast. We already mentioned the fact that the energy prices will influence the cost of food and agriculture, and El Nino is a component, and we have a very nice map showing the expected impact of El Nino. And finally, trade restriction are receding risks, but still important. And the final two slides for me talk about the food price inflation, which has been very, very different across country, and in particularly ECA. You can see the increase due to the Russian invasion of Ukraine. Overall, all of them now are coming down, although to a different level, but still very, very high. Very high prices, very high level of food inflation in the last 3-4 years, between 2020 and 2023, compared to the previous 4 years. And in terms of food insecurity, we have the two main culprits here, which are essentially natural disaster and fragility and conflict. One can see the importance of the relative size of the two bars, of the blue bars in the two charts, and that shows that essentially a very high number of people are very number of people are affected by both natural disasters and conflict with regard as a causes, as the drivers of food insecurity. And that is the end of my slides. I'll now pass it on to Valerie, concluding discussing methods essentially.
Thank you very much, Paolo. Thank you, everyone. Hope you can hear me. So the third group of commodities that we follow are metals, and increasingly so critical minerals, given the energy transition. So I'll talk about how we see those going. Metal prices have really seen broad-based declines. You can see on the left-hand side the base metals, the industrial metals, that sort of had a little bit of an uptick at the beginning of the year. That was when China opened up and everybody got very optimistic, but then found out that actually really demand from China had been weighed down, especially in one of the most important sectors from China, which is the construction sector, which is 25% of GDP and is the one that really consumes the most metals. And just to give you some perspective, China demands 60% of total base metals globally. So what happens to China is very important in this market. So on the right-hand side, you can see that the China Real Estate Climate Indicator, which gives you an indicator of whether the sector is likely to grow, has continued to decline. So we don't expect anything happening on that, and even towards next year. And it's not just China though, because as you all know, the high global interest rates and interest rates that are higher for longer have been impacting a lot of the OECD countries, especially. If you look at the left-hand chart, this shows you the metals demand growth by countries or by groups of countries. And the OECD, pretty much since the invasion of Ukraine, have been contributing negatively to demand growth for metals. Before, because of the situation, so one of the things that happens is that you need energy to refine a lot of the metals, and so they closed a lot of the smelters and were therefore not demanding the primary metals because of the high energy prices. But now, on top of that, you have, of course, subdued growth and high interest rates, which tend to impact sort of commodity-intensive sectors like construction that are also affected by interest rates. But China has been pulling up a little bit, but even though not enough. So sort of the overall line, you can see there's been very little growth in demand for metals. Another thing which I'm not showing here is that supply has been quite comfortable. It's been increasing steadily this year, last year, and actually will continue to increase in 2023, which is 2024, I'm sorry, which is why you can see on the right-hand side that we are forecasting for all of the 6 base metals that we follow, that you're going to see a decline in prices, large in 2023, slightly smaller in 2024, and then in 2025, as Paolo mentioned, a turnaround as the energy transition really starts to kick in. And then I'm going to just show you 3 slides about we're beginning to follow much more as these so-called critical minerals. In fact, some of the right-hand side, you can see that all the critical minerals, it's about 17 altogether, but the ones the World Bank uses, some of them we do follow and we do forecast in the commodity markets outlook. Others we're beginning to look at much more. And you can see that these are all very important and they tend to move together when you see an increase in renewable energy technology. So on the left-hand side, you saw this big increase, especially in lithium. Now they're falling in line with other base metals. And as you can see, very, very volatile, very thinly traded, a lot of protectionism, and the geopolitical fragmentation is really having an impact on them. But we do see that, sort of the underlying structure is the energy transition is really moving along quite well. If you look at the left-hand side, this is a clean energy investment in billions. And even just between 2021 and 2023, there was a 25% increase in investments. This is a global. And that line is expected under all the forecasts to accelerate. So the transition is definitely underway. And of course, that's going to have an impact on many metals. Copper, we don't show it here, but even the ones that are sort of less well known before, lithium, cobalt, and nickel, not only will they be increasingly mined, but also their share, a large share of clean energy, they will be demanded more and more for clean energy. So for example, lithium in 2017, it was 50% and almost 60% already in 2022. And looking more at the long-term issues of metal markets and related to the energy transition is that we know that despite production growth, supply risks persist. And we see 2 large sort of bottlenecks. One is that the amount of time it takes for a mine between discovery and actual production could vary between 4 and 20 years. And that doesn't take into account the fact that there can be issues with, for example, what type of mine it is, whether you have restrictions in the locality, they have a lot of permitting issues. Sometimes they affect communities, they affect water, the quality of the water. And so this could in some ways be sort of the lower bound for how much this would take. And of course, the ores are not such good quality. And then on the right-hand side, you see the geographical concentration of commodity refining. The 5 ones on the right, which are going to be used for the energy transition the most, are concentrated mostly in China and in only a few countries, which is very different to, for example, even oil refining and LNG, where you see a lot of variety. So moving back to sort of other metals, gold prices are the precious metal we follow. As you know, gold prices respond very much to they're used for people who are trying to reduce risks, and gold prices and geopolitical risks are highly related. On the left-hand side, you can see different conflicts that have happened in the last 2 decades or so, and every time you've seen a big pickup, a big streak in geopolitical index, you can see the very last one, which is the Israel-Hamas conflict, and then also translates into an increase in gold prices. And of course, the high interest rates we had, high inflation, many Russia, Ukraine, all of these things have actually kept gold high and very volatile. These are the key risks. I'm not going to go very quickly because Paolo mentioned them, but we did notice two downside risks for metals altogether. There were some production disruptions, trade restrictions. They happen a lot, but they don't seem to be a big issue right now. We do find that China, the assumption is that China's real estate sector will really start to pick up next year, but that is absolutely not guaranteed. There are many issues there. So if that doesn't happen, or if, for example, inflation continues to be high, which means that interest rates need to be higher because of monetary policy, that could also, of course, affect other countries' growth. So this is to the special focus, and what we did in the special focus is, as Paolo already showed you, actually prices moved at the beginning, of course, but ultimately did not have an impact it did not really move very much. And the main reason for that is essentially that Israel and Gaza don't produce oil. So far, if the conflict is contained to the level it is, and it doesn't spread to oil-producing countries, we don't really expect, other than the geopolitical jitters, we don't really expect anything else. But we did want to look at what would be the possible size, if this conflict did spread, under the very unlikely situation that it spread, especially try to compare that to historical events and actually show that actually things have gotten a little bit better over since past years. So here I just show you the picture of, again, just like with gold and with others, you see huge spikes, immediate spikes, oil spikes that are quite common following past supply disruptions. And of course, how long they stay high depends on the scale and the duration of the conflict. So the right-hand side, you can see some of the main large sort of geopolitical conflicts that have occurred. Some, for example, the Kuwait invasion of Ukraine in the Iraq invasion of Kuwait, which took quite a bit from the market, about 8%, had a huge impact on the oil prices, you could see in 1991, but it was very short-lived. So it also went down very quickly. So that determines sort of the duration. So we had 3 scenarios that we looked at of supply disruptions, and we tried to sort of look at what could happen now. As Paolo mentioned, oil prices are expected to be low 80s, $80 per barrel for Brent next year. And for this quarter, they're going to be about $90. In fact, that's what they've been in the last 3 months. They've been around $90 per barrel. So that's our baseline. And then we looked at the different disruptions. First is a small disruption, which would be akin to like the Libyan civil war in 2011, which took about 2% decline in global supply at the time, or at least that was the amount that would have been had Libya been completely closed off for a long time. And that raised oil prices. And using our calculations, we have different ways of estimating, we would assume that that kind of disruption, if it happened today, would raise prices between, say, $95 and $100. A medium disruption, which is global oil supply reduced from 3 to 5%, which is about comparable to what happened during the Iraq War in 2003, would actually raise prices quite a bit more, to about $19 to $31 per barrel, more so between $110 and $120. And the large disruption, which of course again would be more uncertain, would be more unusual if it happened, is oil supply reduction of 6 to 8%. And this is similar to the Arab oil embargo of 1973, which of course raised prices significantly and kept them up for a long time. And that is where you could get into levels of $140, $160 per barrel immediate effect. The good news is that we actually we do believe that the oil markets today and commodity markets in general are much better placed to deal with are more better equipped to deflect these supply shocks, which means that you probably are not going to have a longer or perhaps such a big effect. The first reason for that is reduced oil dependence. So oil intensity has almost halved between 1970 and now. That means that we require much less to produce a unit of GDP. And though oil is still used, mostly transportation most transportation just uses oil products. The rollout of electric vehicles is also providing a way for people, if it happened right now, to reduce their dependence further in the coming years. Secondly, there's also the diversification of sources, right? Natural gas is becoming much more important, as you know, and it's very highly substitutable with coal. They've been increasing a little bit, and they are the ones that have many more uses, especially for electricity production. So as an input into electricity production, whereas oil is really mostly used for transportation. And then, of course, you have this fast growth of renewable energy, which we expect to be using more and more. And it's also becoming cheaper. But even within oil, there's been also different types of extraction, offshore drilling, shale oil, which also in some sense creates some diversity of sources. And finally, the most important is the geographic diversification, which is related to increased trade and emergency stockpiling. So after the 1970s, oil market really, where, for example, in the 1970s, the Middle East was more than 50% of total global supply. Now it's 30-35%, give or take. And you see on the left-hand side that North America, for example, is now altogether is US and Canada are half of global oil supply, even more actually than OPEC. So that's helped. The second thing is the development of oil exchange and future markets. So the introduction of future contracts has had a significant change in oil prices because you really can have price discovery, and it makes the market more efficient. So even though we do see a lot of volatile prices and people, oil prices change all the time, what's actually happened is that they're creating an immediate signal so that demand can respond immediately and you can get to a better equilibrium much faster. In the old days, when you had sort of barter trade and things like that, oil prices could stay, very at certain rates for a very long time, and they were also controlled. And also people can protect themselves through future contracts and through hedging. They can protect themselves from higher prices. Third, the strategic reserves. As you all know, a lot of oil importing countries and oil exporters have significant amounts of strategic reserves, the government, so they can weather for a few months if there are really terrible impacts of some disaster. And of course, OPEC, as Paulo shows you, has ample spare capacity right now. And finally, just improved information with the creation of the International Energy Agency has really helped the oil market flow much better. So that's the good news. The bad news, unfortunately, is that something is going to get worse, and that is food security, food insecurity. We showed you before that food security is worse in conflict areas. Even though food prices have come down, food insecurity is worse. The World Food Program and a lot of these aid agencies are very, very short of funding. They've had to cut this year food distribution to Afghanistan. There are more and more conflicts, and of course now you have the situation around Gaza and the countries affected, where about 60% of the people are food insecure, millions of people. And on the right-hand side, there's another measure of severe food insecurity and malnourishment. And you can see that that's actually been increasing for many years now and is not going to get any better. In fact, we already know that it's gotten much worse since the conflict started. So this, and this is not because there's not enough food out there. As you know, the yields are high. It's really an issue of distribution. So to end, I'd like to end on that sober note, but here's the publications that we produce. And thank you very much. Look forward to your questions.
Thank you very much, Paulo and Valerie, for presenting the main point and main messages of the latest edition of the Commodity Market Outlook, which was released about 2 weeks ago. We received some questions in advance, and also I received one question during your presentation. So let me read those questions and asking you to make comment on. First one, would you please comment on the impact of El Nino on the commodity market in the near future? It's a rather broad question, but if you have any, the comment responses on this, please. Thank you.
So I'll give a hand on that and let Paolo help out as well. Our agricultural economist is not here with us. So yeah, so El Nino, we have actually in general, so if you look at years where there has been the El Nino phenomenon and years where there haven't, you have actually seen higher prices, either because of these flows of, too moistness that creates dampness or dryness in the Northern Hemisphere. Whether that's going to get worse or not, yes, there is some research that just shows that with climate change, these issues are going to get much worse, not just El Nino, but other weather-related issues, which could, all else equal. So in other words, if you compare El Nino versus not having El Nino, does seem to have an effect on prices, simply because you have places in the world where they could lose their crops, floods, droughts, etc. On the other hand, the yields and the trade and the growth in the number of countries that produce a lot of the foods has been increasing so much many years that what you have nowadays, you have a country where suddenly they have a drought and a flood, immediately the prices signal to bring more supplies in. So it's not had a large enough effect that we could really see big differences. But of course that could change, I mean, in the future.
Thank you very much. The second question we received in advance. By the way, those two questions from Sasaki-san, thank you for your question. As always, the ongoing conflict in the Middle East is worrisome. In case it continues for the time being, bringing impact on the commodity prices, what can developing country governments do to deal with? What are the priority policies the developing country government should introduce now? Any response on this, please? Thank you.
Paolo, do you want to take that one?
Yeah, I can take this one. I think yeah, the main impact would be related to a kind of energy prices, as we have seen, and as a consequence, also a kind of a pass-through impact on food prices. Therefore, that is a considerable problem for developing countries. In the long term, one would want to kind of try to introduce energy efficiency and therefore limiting the exposure of the economy to kind of the oil prices and energy prices, and also to increase diversity with regard to the supply and to the sources of supply. And that would be probably not very possible in the short term. And therefore, in the short term, there is one can introduce measures to protect part of the population from any possible spike in prices, and in particular, it would be helpful to have essentially targeted measures where only those vulnerable parts of the population are granted some funds in order to essentially be compensated for the increase on the prices. These targeted policies have been shown to be much more effective than any kind of a blank measure, where essentially, for example, where the energy price or the oil price is prevented from increasing above a certain level, the national energy price is prevented from increasing above a certain level. And yeah, and there are some limitation also to this possibility because of institutional capacity in some developing countries, and also availability of data on which household should be essentially targeted and granted this relief. But in the long term, if that is not possible in the short term, perhaps in the long term, that it would be an incentive for governments to assemble institutional capacity and information on the population in order to introduce more targeted measures.
Thank you very much.
Just wanted to add to that we saw, of course, with the Russian invasion of Ukraine, and we saw huge oil price increases everywhere, and a lot of the countries had huge, especially the oil importers had huge current account deficits and fiscal deficits as a result. And that did really create an incentive to start reducing fiscal subsidies, especially to fossil fuels, and hopefully that will continue as they also move towards, as Paolo mentioned diversified energy and move along the energy transition, which is not just something that advanced economies should be doing, but also developing countries.
Thank you very much. I have one question from anonymous participant directly sent to me during the presentation. Do you think the price of coffee will be rising in a longer term because of the climate change, or price will be rather stable for the time being? Well, I think perhaps this person is a coffee drinker, maybe. So any comment on this? Thank you.
If I try this one, I mean, as a caveat, perhaps worth mentioning that our team doesn't go beyond the 2 years with the official forecast. So that's the rest take it with a pinch of salt. The reason why we don't do long-term forecast for prices is because there are so many factors affecting the long-term direction of price, and it's really difficult to have a firm grasp of how those factors will evolve. On the slide 25 of the presentation, we have a nice chart of El Nino and showing the impact in Brazil, potentially drier kind of weather in Brazil and also in Vietnam. Those are two the main producer of the Arabica and Robusta type of coffee, and therefore in the short term we expect a kind of an increase in the price of coffee. In the longer term, is difficult to say. That will depend very much on the kind of amount of land dedicated to this crop. But overall, we can say we would expect first of all a decrease as essentially the effect of El Nino is subdued, and perhaps going back to coffee prices have been very high since 2021, and perhaps we would expect that trend to revert and to go back to kind of a longer term average.
Thank you very much. So in response to the question that we received in a very efficient manner. So before wrapping up, I would like to ask both Paolo and Valerie to give our audience a final messages, final words, then we wrap up the seminar. So Paolo, any words, final words from you? Thank you.
Any final word for me is about the uncertainty in the energy sector, in particular related to the conflict in the Middle East, but also very much to the demand from China, and that affects considerably the natural gas LNG market, which is something that probably you guys look at very closely. Important also to keep an eye on China and India with regard to coal consumption, as the two countries have 80% of the worldwide, so global consumption. And the energy transition is definitely starting to have an impact on the mainstream fossil fuel energy, and any policy facilitating the energy transition seems to be in the long term a good insurance against the exposure of national economies to the volatility of international commodity prices.
Thank you very much. Valerie, please.
Yeah, I agree with Paolo that in the short term, for example, natural gas still has a lot of uncertainty. I mean, it was really the commodity that got the double shock, right? Because the Russia, Europe has immediately moved to LNG, but LNG is also still very new, and there's a lot of transportation issues. So I would put that commodity as the one to watch out for the most, so to speak, which also affects Japan, of course. But for other commodities in general, and of course you can't generalize completely, but for many other commodities, oil, any commodity where you see diversified production and large trade and countries not putting trade restrictions on, generally, yes, you do get spikes here and there, but prices come down very quickly. So, my advice to all commodity producers and consumers is don't put restrictions or anything. They usually backfire, and they also create havoc for commodity importers, right? For these countries that, especially pork commodity importers that have to, have to deal with issues at home, and on top of that, balance of payments, terms of trade volatility. So yeah, that would be my message.
Thank you. With us this morning, connecting from Washington, we had Paolo Agnelucci, who is a senior energy economist, and also Valerie Mazza-Blackman, the lead economist, both from the Prospect Group of the World Bank, presenting the Commodity Market Outlook latest edition, which was released 2 weeks ago. So thank you very much, both of you, for your time to present and respond to all the questions. Thank you. Really appreciate it.
Thanks to you and to the audience.
Thank you. Thank you for having us. Yes, thank you.
Great, thank you very much. So we'll continue organizing these online morning seminars. For the latest information, please check our website. We'll have interesting seminars coming up. So with that, thank you very much and see you next time.
Thank you.